Hello, and welcome to this month's 3 Slides in 3 Minutes. The Magnificent Seven's trading volume is starting to rise after hitting very low levels. The last time this happened, November 2021, just before the stock market crashed in 2022. The blue line is the rolling 1 year average volume. Why does this matter? When trading volume jumps, it often means investors are getting nervous. In the past, big increases in trading activity have signaled either excitement or fear, both of which can lead to big market moves. Right now, the pattern looks a lot like 2021, when stock prices were high, confidence was strong, and then suddenly the market dropped. This alone might not seem like a big deal, but when you add in other signs like high stock prices, concerns about the economy, it raises questions. Could we be seeing another warning sign before a downturn? There's no way to know for sure, but history suggests it's worth paying attention to. When thinking about where investors should be today, the first takeaway is balance, having a chip in every square. Markets move in cycles, and diversification ensures that you're positioned for whatever comes next. That said, there are key dynamics at play. Value stocks tend to outperform when economic growth accelerates since they're more cyclical. Large cap stocks have more international exposure, which means that they could be hurt by a rising dollar and uncertainty in global growth. Small cap stocks are more tied to the US economy, benefiting from domestic strength but carrying more volatility. Growth stocks have led for much of the past decade, but with some valuations stretched, selectivity matters. Looking at valuations, some styles and sizes are more expensive than their 20-year averages, making rebalancing critical. Investors should ensure their allocation aligns with both long-term goals and today's market realities. Bottom line, stay diversified, be mindful of valuations, and adjust strategically, not reactively, to position for long-term success. On this slide, we have year-to-date returns for value, growth, large, mid, and small. Above that, and you can see value is outperforming growth year to date. And above that, this is the current PE ratio versus the 20-year average PE. So you can see growth is something like 150% over their long-term PE. And you can see value is a much smaller number. And quite honestly, small value is in the same boat, has not moved or appreciated greatly. And then on a year to date basis, here are the sectors that are performing and their returns. So again, financials, communication services, and materials lead the pack. The sharp increase in home delistings signals a shifting housing market with both risks and opportunities for buyers and sellers. On the pro side, sellers may be just simply waiting for a stronger spring market, hoping for better offers as demand picks up. Home prices have remained resilient despite weak sales, and for now, delistings act as a buffer, allowing homeowners to avoid cutting prices. However, the cons are mounting. The surge in unsold inventory suggests that demand remains soft despite a rise in economic and available properties. If mortgage rates stay elevated and economic uncertainty lingers, sellers may be forced to adjust expectations, leading to broader price corrections. Typically, home sellers are about 6 months behind in their estimation of the value of their home. Builders struggling to move inventory are already offering incentives, hinting at potential downward pressure on home values. If delistings persist into spring, we could see an influx of shadow inventory, adding more supply at a time when buyers remain hesitant. For investors and homeowners alike, the key takeaway is to watch pricing trends and market activity closely. Because if demand doesn't rebound soon, home values could face greater headwinds. Thank you. If you have any questions, please reach out.